you're sitting over, I'm assuming you're sitting right now over in the UK watching this play out. What Joe said, you know, they're blinking, but what does this do? What are the knock-on effects that we haven't maybe thought through yet?
Thank you, Becky. Yes, I am in the UK, and it is amazing that this is a G7 country that over the last 6 days has experienced disorderly moves in the currency and in bond yields, a loss of confidence in policymaking, now direct central bank intervention, and an IMF warning. All this normally happens in a developing country. It does not happen in a G7 economy. So this is historic. It points to the paradigm shifts that we're going through and the fragility of markets. The U.S. is a safe haven, so this does not mean the U.S. will go through this, but it means that the U.S. is having to navigate through this. In the short term, the U.S. will benefit from this, but it comes at a time when the strong dollar and the yields are also damaging the rest of the world. So it's not a good combination, Becky.
What does this mean for Liz Truss? I mean, they had the expectation that the markets would take this. The markets did not. Now what?
So what it should mean is she should keep the two elements of the package that everybody welcomes, or almost everybody, which is structural reforms to promote economic growth and the stabilization of energy prices. And she should rethink the timing of these unfunded tax cuts. It is that third element that has completely undermined the first two, and that is basically going against the objectives of the government. Now, doing that is really hard. And if they don't do that, the Bank of England is going to be forced into the next intervention, which will be an emergency rate hike.
Mohamed, what is the perfect world? Is it a world where central banks are synchronized and they tell each other what they're ready to do? Do you think this was a surprise to the Fed here? And is it? I've seen two takes already on Twitter. One is finally someone's doing the responsible thing in terms of data dependency. And then I've seen another that said, well, now we know how firm their resolve was over in the UK. They have feet of clay. I mean, how do we view it long term? Do we want the world's central bankers synchronized in tightening to conquer inflation, or do we want people to go their own way based on their own currency or their own circumstances?
So first of all, this has nothing to do with data dependency. The data dependency today would have meant a more hawkish central bank, not a central bank that puts in liquidity. The numbers that came out this morning in the UK showed that prices at supermarkets, the inflation rate is going up. So this is not data dependency. Right. This is responding to the risk of market malfunction and real concern about financial accidents. This is what this is. Now, it goes counter to what they need to do for inflation. So it highlights the inconsistency of monetary policy. Look, Joe, you and I have always warned, the longer you stay in this la-la land of QE, flawed interest rates, dislocated markets, funny interventions, distorting asset allocation, the longer you stay in, the harder the exit. And what we are seeing is that the exit is really complicated.
Mohamed, I guess the data I was talking about was the pound and equity markets around the world. So that's more of a Fed put data, and obviously that's not what central bankers should respond to. But you see what I'm saying? I'm not talking about the inflation data. Yeah. I'm talking about the effects that the tightening is having. Do you think the Fed should take that into account with what's happening? 7% mortgage rates? I mean, maybe they needed to look around.
Well, if they worried about mortgage rates, it's because they're worried about the impact on the real economy. What they cannot do because of inflation is provide an in-the-money put. They just can't. Those days are gone. I think all of us have to recognize that we are going through a major paradigm shift in financial conditions. Central banks have to step back. They overdid it. They were late in recognizing what they had triggered, and now they need to step back. The problem is stepping back is very risky. And the last thing the Fed wants is to find itself in this major inconsistency that the Bank of England now finds itself in. It was about to do QT. It announced that it would hike even more aggressively on November 3rd, and now it's injecting liquidity.